Good evening and welcome to another Closing Bell Market Update. Today is Wednesday, the 17th of May, 2023. And here's today's agenda. As always, we will start off by summarizing today's trading day, and then we will move on to the special topics, starting off with the bank sector regaining some confidence today. We will also talk about the debt ceiling and some surprising resilience in the housing market. This was indicated by some data that was released throughout the week. We will also look at earnings reports from retailers. Says a lot about the underlying strength of the consumer. For example, we got earnings from the TJX group and from Target. And we will kind of talk about what all of this data means from a macroeconomic perspective. And of course, I will also explain how these topics that we're going to talk about affected the performance of the market today. All right, but first of all, we will summarize today's trading day. Let us take a look at the US major indexes. The S&P 500 up by around 1%, increased to 4,153.09. The NASDAQ 100 plus 1.1%, the biggest gainer within the major US indexes, increased to 13,573.5. And the Dow Jones Industrial Average up by around 1% as well, and increased to 33,370.13. All right, US Treasury yields. We are seeing yields up across the curve, short end, long end, belly of the curve. If you look at the 5-year Treasury yield up by 2%, at the very long end of the curve, the 30-year Treasury yield up by 0.36%, and at the very short end, the 13-week Treasury bills up by 0.7%. Clearly reflecting that markets are becoming more optimistic right now based on the economic data that is being released, including data on the housing market and retail sales as well. All right, let us get to our first topic today, which is the bank sector regaining confidence. You can beautifully see here on the chart the shares from Western Alliance, Zions, and Pacific West. Western Alliance and Pacific West have come under significant pressure this month already. We have seen these shares, they were down by 50% at some point. You can see right here, we have seen a sharp drop here. We have seen a short drop here in May already. But if you look at the balance sheet of these banks, they have enough liquidity to cover uninsured deposits. Now Western Alliance has actually announced that they have seen an increase in deposits and also at the same time an increase in insured deposits. And if you look at the balance sheet of Pacific West as well, or in general of most regional banks, the balance sheet of those banks is looking relatively stable. Now, the problem with banks basically coming from an era of easy money and the Federal Reserve raising interest rates so quickly, we have started to see a problem on the asset side of the balance sheet and on the liability side. Now, assets are deteriorating in value. If you look at mortgage bonds, if you look at the long-term treasury bonds, these are, of course, deteriorating in value when the Federal Reserve raises interest rates so quickly. Now, the Federal Reserve has been doing quantitative easing for a very, very long time. Now, this what we have seen is actually deposits have increased more than the demand for loans, which has caused a lot of banks to invest. They have basically been incentivized to invest, also due to very, very low interest rate. They have been incentivized to invest in these very long-term bonds at the end of the Treasury yield curve. Now, what happens to these bonds? These are especially sensitive to interest rate hikes. So when the Federal Reserve essentially raises interest rates from 0% to above 5%, we're at a range right now from between 5 and 5.25%. This basically, the value of these long-term bonds deteriorates. And if you then see a deposit flight, like we have seen with Silicon Valley Bank, of course, these banks are forced to sell these long-term assets at a significant loss in order to ensure deposits. Now, what this essentially does, this problem on the liability side of deposits and on the asset side, the deterioration in value of the asset side, this basically means that the underlying collateral of assets or the underlying collateral in the form of assets against the liabilities of deposits deteriorates. That collateral deteriorates, and that should put banks in a pretty peculiar situation. However, like I said, the balance sheet of most regional banks is in a pretty healthy state. So we are seeing that some confidence is regained. especially because we're not getting any new bad news from the sector. So that is definitely a good sign, especially also an indication that the Federal Reserve, this is another topic that the Federal Reserve will probably be less worried about. When these events started, Silicon Valley Bank, First Republic Bank, Signature Bank, the markets, they were basically saying that this could pose a policy implication for the Fed, because the Federal Reserve is basically in a trilemma. They need to ensure price stability, financial stability, and full employment. Full employment, we are at an unemployment rate of 3.4%, no problem. Financial stability, we started to get worried about this. Also, if you look at the Senior Loan Officer Opinion Survey, we are seeing some definitely credit tightening, right, as net interest income of banks starts to come under pressure. But like I said, balance sheets in a pretty healthy state, no new bad news from the banking sector, obviously reflects, creates some confidence in the economy as a whole, in stock markets as a whole. All right, very glad to see this, actually, very happy about this today. But a little less happy about this topic, but still we are getting some optimism from the debt ceiling debate as well. Basically, yesterday, Kevin McCarthy and Biden had a meeting. They talked about raising the debt ceiling, of course. McCarthy wants the Democrats to agree to significant spending cuts. Eventually, they will meet somewhere in the middle. It is still open to what spending cuts Joe Biden will actually agree to, but I definitely expect some, because McCarthy will not agree to raise the debt ceiling if he doesn't see some spending cuts. Now, we got some optimism from that meeting, actually. What we have seen in the meeting is both parties have made it clear that a technical default on the X date is unacceptable and will not happen. Kevin McCarthy said yesterday, we could be reaching an agreement by the end of the week. This creates some optimism in the sector. Now, I would like to mention a quote here from Jim Wright. He's a strategist at Deutsche Bank. He said today that, quote, the market was really waiting for the results of the latest meeting on the debt ceiling between President Biden and congressional leaders starting an hour before the US closed on Tuesday. President Joe Biden announced that he thinks there was consensus among congressional leaders that defaulting on the debt is simply not an option. Senate leadership from both parties exhibited optimism that a deal could be reached as well. What this did today, of course, pushing equities up. So we are getting some optimism here. Very glad that we seem to get closer to a resolution on this matter. Technical default, even though if you look at financial institutions, they are using a lot of resources to actually analyze how a potential default could affect financial markets, because right now the effect in general remains unquantifiable, because it would be a horrible event. So I'm very, very optimistic that congressional leaders, Joe Biden, that they will reach an agreement. All right. Surprising resilience in the housing market. The housing market is a sector that is very sensitive to interest rate hikes, just like the manufacturing sector. The service sector, for example, is a sector that is very insensitive to rate hikes. But we are seeing some optimism in the sector. Clearly a slowdown, yes, but maybe not as bad as many anticipated it to be. And this unexpected rebound definitely creates some optimism today in capital markets. Let's get to some of the data. Housing starts rose 2.2% in April from the previous month. Economists expected a decline of 1.4% to 1.4 million, according to FactSet. Now, the adjusted annual rate is now at 1.401 million. Let's look at some more data. The single-family building permits increased by 3.1%. Overall housing permits down by 1.5%. This is very interesting. If you look at mortgage rates averaged 6.31% last week, clearly coming off from a peak of 7.08%, which was reached in November. Interesting that the mortgage rates are falling again to some extent. But the number of houses approved for construction yet to be started declined by 1%, which is the lowest level since last June. Now, this does indicate that there are no new approved housing. There's no new construction in the pipeline. And regarding this, a very interesting comment today coming from Robert Frick, corporate economist at Navy Federal Credit Union. He said that, quote, Given these weak numbers for new homes in the pipeline and the extremely low level of existing homes for sale, the current weak state of the housing market looks to continue this year. I obviously expect the same thing, but the fact that we are seeing this, if you look at the chart here, the fact that we are seeing this surprising upward movement in housing starts represents some surprising resilience in the housing market, which could be interesting to the Fed, a sign of optimism about the general state of the economy for markets. But in general, of course, this is a sector that is very sensitive to rate hikes, and the Federal Reserve raised rates from 5% to 5, from 0% to 5.25% now. And yeah, this is a sector that will continue to suffer under increasing mortgage rates. All right, more economic data, microeconomic data. In fact, a Target reported earnings today. Let us go over these numbers here posted by Yahoo Finance. Net sales up by 0.6%, increased to 25.3 billion versus an estimate of 25.18 billion. So here revenue coming in slightly above expectations. Gross profit margin 26.3% versus an estimate of 25.7% compared to a year ago. 26.3% gross margin versus 25.7% a year ago, and estimated was a value of 26.52%. So gross profit margins coming in a little bit below expectations. Inventory growing at a slower pace, actually minus 16% year over year versus an estimate of 5.1%. So that is definitely a significant trend and a significant surprise to the downside here in inventory growth. Now, earnings per share minus 6.2% year over year, fell to 2.05 versus an estimate of only 1.8. Now, overall, we can definitely say that these reported earnings beat estimates. The share is also up. I don't have the exact level here on the slides right now, but shares are up on the day. However, and this is a trend that we have seen in the earnings from retailers so far, we are starting to see signs of cooling down in spending in discretionary items. So consumers are more spending, obviously, on necessities, less spending on consumer discretionaries, indicating a consumer that is starting to lose some resilience. Now, the expected sales are expected to remain sluggish throughout the year. And if you look at comparable sales, which tracks sales at stores open at least 30 months now and online, they are expected to range from a low single digit decline to a low single digit increase for the fiscal year overall. So definitely Target, the outlook is not great, indicating that this retailer is expecting the consumer to lose some of his or her resilience throughout the fiscal year. All right, let's get to TJX earnings report. A lot of companies are part of TJX, for example, TJ Maxx. And if you look at revenue of TJX companies, you can actually see revenue coming in below estimates, right? It came in at 11.78 billion versus an expected value of 11.82 billion. Earnings per share second quarter guidance is between 72 and 75 cents versus a 79-cent estimate. And the full fiscal year guidance fell short of estimates. Same trend as we're seeing with Target. Reported earnings right now relatively well, indicating a still resilient consumer, but these companies are expecting the consumer to lose resilience throughout the year. All right, no more notes here. Let's take a look at this from a macroeconomic perspective. And I also want to bring in some more other data that was released, starting off with the labor market report, right? The labor market report from April showed the unemployment rate fall to 3.4%, is a 69-year low, in fact. At the same time, payrolls are still above 200,000. I will probably sound like a broken record here, but I want to mention it again because it is incredible and it shows you that the Federal Reserve essentially has to or will stay hawkish, at least based on this data. Now, during 2019, that was a period of economic growth, unemployment rate at 3.5%. The 6-month average payroll number during 2019 was 167,000, right? 33,000 below the current level, more than 33,000 because payroll number are coming in above 200,000 as indicated by the last labor market report. So this just puts into perspective how tight the labor market is. At the same time, we are seeing the consumer remain very resilient. Of course, the fiscal year guidance is not looking so great, right? But we're still expecting growth in the increase within single digits right here. And for example, a Target said that, right? Expecting growth of single digits, could also expect a single digit decline. So we are seeing this resilience of the consumer. Now, if you look at the current GDP level, we're essentially 1 million jobs short at the current GDP level, and most of these jobs are missing in the service sector. So in general, if you think about it, the consumer continues to spend, as also indicated by the latest retail sales data released yesterday, I believe. The consumer continues to spend, which is basically due to a tight labor market, low unemployment rate, and still a very high number of wage gains, right? We're seeing high wage gains throughout the economy. So all of this essentially indicates that inflation, it will be hard to bring inflation to 2% if you have such a resilient consumer. Larry Summers from Wall Street, from Harvard, he used to be the US Treasury Secretary. He said that you cannot get inflation down without getting wage inflation down, and you cannot get wage inflation down without seeing slack in the labor market. So I believe essentially the data that is being released at the moment, labor market report, consumer spending, housing market, all of this data, this does not give the Federal Reserve sufficient evidence that inflation is indeed on a sustainable downward trajectory. Now, what the current retail sales data is showing, what these earnings report from Target and TJX are showing, is that we might be crawling towards a recession, but we're definitely not sprinting towards a recession. So I believe if we continue to crawl towards a recession throughout this year, the Federal Reserve will not cut rates because it doesn't have a reason to. If inflation remains high, and if you look at the recent CPI report, recent PCE report, inflation remains much too high. If inflation remains high and we continue to only slowly crawl towards a recession, the Federal Reserve has no reason to cut rates this year. Simply speaking, of course, it is hard to make any predictions. We will have to continue to assess the data that is being released. But overall, if we look at the current state of the economy, while taking into account that consumer spending is indeed slowing, I believe the Federal Reserve will not cut rates this year, right? I saw a very nice chart on the Financial Times today. It showed that retail sales are indeed starting to come down, but you also need to consider from what level these sales are coming down from, right? Because during the pandemic, all of that stimulus that was pushed into the economy, we have seen a significant increase in sales, a strong consumer, a lot of spending, and that is slowly coming down, maybe to pre-pandemic levels, but it is still, the consumer is still very resilient. Okay, before I continue to sound like a broken record, let us take a look at how today's topics affected the markets. Now, the bank sector, obviously pushing up equities, pushing up yields because people are selling off fixed income right now because I need to phrase this differently. Bank sector, the fact that we are regaining confidence within the sector is putting upward pressure on equities, upward pressure on treasury yields, right? It is very good that we're not getting new bad news from the banking sector, balance sheet of regional banks in a relatively healthy state. Debt ceiling, more optimism about resolution and no technical default, right? That creates optimism in the markets, putting upward pressure on equities, and upward pressure on yields as well. But you need to consider the debt ceiling. If we don't get a resolution, that will also put upward pressure on yields because obviously people would be selling off bonds in such a case. So just in general, putting upward pressure on equities here. Housing market and the retail sales data is showing that we're crawling towards a recession. We're not sprinting towards a recession, like I already said. Obviously also putting upward pressure on equities because it essentially means that the economy remains resilient. Now, I would like to talk, before we finish it off for today, I would like to talk about the efficient market hypothesis, right? The hypothesis that everything is actually priced into markets correctly, that information is priced in correctly any information that is being released. Now, the markets don't believe rate cuts. The markets believe that we will get 3 rate cuts this year by the Fed as soon as June already. Now, you need to think to yourself, you need to think about why are markets actually pricing that in? They look at the current data, they assess the information that this data has given us. We are seeing the economy remain resilient. At the same time, we are seeing inflation come down, right? We have seen CPI come down, even though core CPI, core PCE, excluding food and energy prices, remains very sticky. We are seeing inflation on a downward trend. At the same time, we see the economy remain resilient. This gives this idea of an immaculate disinflation scenario where we get inflation down without a significant rise in the unemployment rate. Now, obviously, the markets see that and they price in rate cuts and they price in an optimal scenario because that is the information that the economic data is currently giving markets. You need to consider data is backward looking. You need to question, will inflation actually fall to 2% while having a resilient economy, right? We're seeing inflation fall, but we don't know to what level it will fall. It might stop at 3%. It might stop at 4%, definitely above the 2% limit. So these are all things that you need to consider. You need to consider that data is backward looking as well. But what the markets are doing, just like the Federal Reserve is data dependent. They don't have a strategic outlook. So what markets will continue to do, what the Fed will continue to do, is assess the economic data that is being released. And based on this data, they will predict some scenario. So what we need to do, what economists need to do, what obviously the markets are doing, they're looking at the data, and based on this data, they're pricing in some scenarios. So what I will continue to do, I will continue to sit on this chair. I will continue to look at the data that is being released. And based on that data, we will simply continue to analyze what this data means for the further development of the economy, and hence also the further development of monetary policy. All right. And with that, we will call it a day. End of presentation. I hope you enjoyed today's closing bell market update. We are still 19 minutes away from the closing bell. So these levels of indices and treasury yields are not 100% up to date, but still, we definitely summarized today's trading day, summarized all the data that was being released. Another great day, another nice analysis, and see you back here tomorrow.